Good morning, guys. My name is Omoimu Festus. I'm a Nigerian. Let me give my disclaimer. I'm not a financial advisor. Neither do I give financial advices. I'm not registered with any financial institution. This video is for educational purpose only. And as we all know, past profits do not guarantee future results. You trade at your own risk. No strategy is a holy grail. This is Btmm versus ICT. Is a combination of Beat the Market Maker by Steve Morrow and ICT Inner Circle Trader by Michael. It's a strategy that has proved its worth in the forex market, and it has been consistent. I'm doing this presentation to teach us on how to trade the forex market with Beat the Market Maker. But before I start, I will highlight some key and vital information about the forex market. The forex market is about knowing when to buy and when to sell. Okay, so and as a trader, you ought to know when to buy, when to sell the market. Many persons in the past have tried to, attempt the market in various ways, and they have failed. There are over a there are a lot of strategies in the market. More than 1,000 strategies over the years. As many have struggled to come up with something good so that they can be successful in the forex market. But over the years, not until 2009 to 2011, Steve Morrow, made the best attempt so far by introducing the market maker. Okay, when I went through his course, my eyes were open about who the market maker is, what he does, and why he moves the way he moves. The market maker are they are the institutional traders, the big boys in the market. They are the ones who come with over 90% of the liquidity in the market. They provide a liquidity pool. So they come to the market with over $5.3 trillion. While every other person in the market is called the retail traders, like you and I. Know one thing, that you can never win. You can never win or make them go broke. They are just like the wave of the sea or in the ocean. You cannot beat the wave easily. You have to swim with the wave in order for you to succeed in this market. So that is what Steve Morrow did. Steve Morrow was able to introduce the Btmm and everything needed. So if you have gone through the Btmm course, your eyes about the forex market will be open. And it does not stop there. There are a lot of things that Steve didn't talk about that, according to a guy I met recently, Cameron from South Africa, he said Steve Morrow's method are dated, and he came up with something else. And when I listened to him, I agreed with him. But though they're almost the same, but his approach was far will I say better. An upgrade of Steve's methods. Okay, so I will talk about the Btmm and a little bit of ICT. I'm not a conversant with ICT, but I learned ICT from the ICT auto blog. Though I've gone to the course, but a mentor known as Ronaldo Beijing, made me grasp the concept of the ICT method in trading, combining Btmm and ICT. Every other thing in Btmm, in this strategy I'm going to talk about, every other thing in Btmm plays very, very well. The monetization M, the peak formation highs and low, the sessions, the bring straight, the signature trades, everything, MCW, name it, the TDI, everything to work perfectly. But where people have issues is their entry, how to enter the market. And whenever you enter the market, the way to enter the market, you're not going to see if you buy from the peak formation high, peak formation low, okay, from on the high of the day, high of the low, those kind of things, fine. But Camo nailed it in a way that that the market makers, what they do mainly is the chase volume, the trade volume, in the sense that the higher the time frame, the higher the volume. That volume is where the money is. So the market maker is just like a person according to him. I'm bringing in Camo now, just like a person according to him, or a group of people that they do one job. Their own is to locate where they know where volume is, so they bid price to that particular location. But the retail traders, they don't know about it. They bid price to a particular location, they drag price to that place, then they crash the market, okay? And we know, according to Steve, that the market has a pattern, okay? We shall talk about the consolidation of the Asian ring box. Then a stomp hunt to the high. The market maker, they move a stop onto the high. Then they do three levels of three levels, level 1, level 2, level 3. We talk about the long sustain run. And in the London, the New York session, they do a reversal. Then the consolidation continues again. So this is just the market maker pattern. So if you know about this pattern, and this pattern plays out on a daily basis, it plays out every day, but sometimes it is clear, sometimes it is not clear. Sometimes the trade follows the trend, okay? It follows the trend, and sometimes it follows the pattern, okay? And we all know Btmm has some specific indicators in which you can use to help you trade the market very well. And trading Btmm, the time frame is on 15 minutes. Why on 1 hour we talk about the levels counting? But here I'm not particularly about the levels counting. I'm talking about the combination of Btmm and the ICT, how to trade Btmm using ICT approach for the entry. The ICT approach, I call it a sniper entry because it's the best entry that I've ever seen in this market, and it's accurate if only you can combine both of them. Okay, like what Camo said, that the market maker, just one person or group of persons, all he does is he collects volume. He knows where volume are, so he bids the price to a particular level, and then he when the price get to a particular level, like here, for instance, I will talk about this place, okay? Like here, for instance, then when price gets to that particular place, the price has a particular behavior it will give. Then it will go its way. They'll induce people to buy. To induce people to buy, they'll give a spike to the high. Spike to the high when the price gets to a particular location. The inducement will be in a way that buyers will flood the market, for instance, like here, or sellers will flood the market, and what they do next is, like here, first sellers will crowd, we flood the market because of this bearish candle. Okay, so they'll crash the market and they will reverse the market. So with some indicators and some tools, okay, because this Btmm and ICT is just like we are trading price, okay. So that's why we don't have lots of we don't have a normal Btmm session identifier in this chart, okay. So as a trader, you have to train your eyes to do without them. You have to train your eyes to do without them, to have a clearer chart and come and do what's called a clearer and a better analysis with that. Okay, so they induce people to buy. They give false move according to him, and they bid the price to where volumes are. Okay, then they fake out the traders and they go the opposite direction. So and according to him, the higher the time frame, the higher the volume. So it's like many persons who trade 15-minute time frame, they are scalpers. They are not they're scalpers. So their stop losses are always 10 to 15 pips. So that is why the market maker does not bother about them. Okay, it goes to a higher time for like 4 hours daily, because that's where majority of those who have big money in the market, that's time in the trade. People that have 400,000, 500,000, $1 million, 2 million. Okay, they trade a higher time frame, because that's where, because those who trade the swing traders and the position traders, their stop losses, they are up to like 100 to 150 pips. So that's money for you. That's a whole lot of volume. So the market maker chases people with that trading 4 hours, 4 hours daily time frame weekly. So that's where the bulk of the volume of the market is located. So as a result, okay, he targets people in that particular time frame. Okay, he targets people in that particular time frame, and why those in 15 minutes, he just like he'll make a move to shake them off the market, and boom, and that's it. So what we're actually doing, like what Cameron said, he said that that okay, so now we've known what the market maker does. That he trades. He what he does is that he chases volume. Okay, he knows where the volume is and beat the price to the part of the where the market is. Like what Cameron said, that you cannot see volume with your eyes, but when price gets to a particular location, you can identify that, okay, there's volume. He said two things, that that the market maker cannot fake two things, cannot fake a shark fin. Okay, as we all know, this is the shark fin. It's a shark fin when the RSI breaks above the volatility band and comes into the market again. Outside the volatility band, back into the market, there's a shark fin. And whenever you have a shark fin move, okay, you likely see the movement of the market. Yeah, this is something like this. You already see the movement of the market, in that particular direction. Okay, so you have to study the TDI very well. So you have to study the TDI very well to understand what I'm trying to say. Okay. Uh, so there is that. So the places that volume are found, he gave an instance of some locations, like that where price get to particular level, like the higher low of the day, the higher low of yesterday. Okay, and like what we have here, this is the high and low of the of the day. Okay, this is the high of the day, and the high of the day, and the low of the particular day. This is a particular trading day, which is on Thursday. No, on Thursday. I'm using this place because I will talk about this method from here. This is clearer from here. This is the high and low of Thursday. This is the low. This is the high. So the places that volumes are found on 15 minutes time frame is on the high and low of the day, higher low of yesterday, then higher low of the week. If you go to 4 hours, you see the higher low of the week. Okay, let me go there and show to us higher low of the previous week, higher low of the month. So when price get to this higher low of the previous week, of the week, sorry, of the month, and of higher low of the week, higher low of the month, higher low of the day. When price gets to these particular positions, they give us some signs. Okay, like so I have the indicator that tells us this is the higher low of the month of or the previous month. This is the previous week's high. You can see that when price got here, price reacted somehow. There's a reversal, and also okay, and also some positions. I will show us a very clear chart. You can see like here, like here, okay, like here, okay. So these are places that when price get to, they behave somehow. Okay, so when you have some kind of reactions there, like here as well, you know that yeah, that that these are the places that volumes are what are located in the market. So when price gets here, the market maker, tends to go in opposite direction. Okay, so it will induce buyers. Like here, you can see two spikes candle. Okay, so the swing trader we think that this price wants to go up above this, so he he will enter the market and boom, here it goes. The market maker crashes the market. It goes up to like this is 290 pips against him, and why he has been taken out of the market. So these two spike. We tell the swing trader that the market wants to go up more. Meanwhile, if he does not know the secret that I'll be sharing since he will be taken out of the market because his stop loss is up to 100 to 150 pips. So he's taken out of the market. And imagine he has up to like he entered the market with 10 standard lots. Imagine how much he has lost. So these are some of the secrets that you have to know if you want to be successful in the forex market. So so on 15 minutes time frame, let me talk about this Btmm strategy. Like what I said so far, the ICT is what they do is a price action strategy. Okay, they trade price. They don't trade indicators and whatsoever. Why you need the Btmm indicators to like identify some key levels and some key issues, some key factors that will make you trade the market very well. Like what we have here, the list of indicators are here. We have the peak formation low and high indicator that helps you identify peak formation low and high. We have the EMAs, the exponential moving averages that are used for entry. Close above the ketchup, we have the 5 EMA, we have the 13 EMA, we have the 50 EMA, we have the 200 EMA and the 800 EMAs. Then we have the daily high and low. This is the daily high and low. The yesterday high and low. Sorry. then I talked about the weekly, the monthly, previous month high and low indicators, which tells us where the prices are located. Then we have the market open and close. Then we have the TDI, trade divergence, the trade dynamic index. Then we have the quarter theory. So I'll talk about the quarter theory when I get to the 4 hours. Okay. So I'll talk about that, but let me know those balls. It's a lot of things in this market. Okay. So is paramount as you trade Btmm, you should understand the pattern. Okay, the pattern which has talk about the accumulation phase. This is the intraday cycle. We have 3 kind of cycle. We have the intraday, we have the monthly cycle, and we have the weekly cycle. This is the intraday cycle. It's same pattern, the accumulation, okay, which is the Asian range boss, the stop on to the high or stop on to the low, then the long sustainer and the reversal. On the weekly cycle, it is still the same. On the weekly cycle, we have Monday, which is accumulation, Tuesday, which is a stop on to the high or to the low, Tuesday, Wednesday. Sometimes on Wednesdays and Thursdays we have the long sustainer, and on Fridays we have the reversal. Then into the new week, you have another consolidation. So the purpose of this Asia range is for collecting accumulation of contracts. They collect contracts and they move to the top to stop them high. So they collect contracts and pending orders. People who send pending here thinking that the price that the price is going to buy from them according to them. So they'll set pending orders from here in this location. So what the market maker does is that he collects those contracts and he stops them out and he goes his way in opposite direction. So if you can understand this pattern, you go do it in the market. Sorry, I didn't close. I just shut down my okay. I'm gonna be the stop for now. So that is just the pattern. So what I came up on, what I finally did was that I was like harmonizing Camel's trading of volume analogy with Steve's analogy of the pattern and also the ICT entry, which is the order block, which is the order block. So let me remove it here from here and remove this pattern and everything that's in the chart to have a clearer chart. Okay. So according to Steve, you trade. The safety trade is when you trade from the peak formation high or the peak formation low, and on a daily basis. So you trade mainly from the peaks formation high or the peak formation low. If you trade from there, you have a safety trade though. So you don't trade on this Asian range, except you're trading the NZD pairs, JPY pairs, and these other pair, and NZD, JPY, and these other pair. This is Asian pair. And AUD, yeah, and AUD. These are the three pairs that moves in the Asian session. Unless you traded them, you can focus on those pairs on the Asian session. But when you're trading the London session pair and some other pair, okay, the pattern is still the pattern. It plays out on any session just for you to like identify them in the market. So, like I said, volumes are found. So we are focusing more on volume than any other thing in this market. Where volume are located, that's where the money is. So since we have that idea already, like I said, the volumes are located on the high and low of the day, and high and low of the yesterday. Okay, and like also according to Steve, you can identify when price is about to reverse. Okay, you a lot of pains from the top. Okay, pains from the top and pains from the bottom will be given from the market. So you can know that on pains from the top, pains from the bottom on uh, on the peak formation high or peak formation low on some key levels, you know that that the market maker wants to reverse the market. So with that idea, you can know when I want to enter the market. Okay. So like what I said. So here on 15 minutes time frame, you can see this place. Okay. And when you trade this strategy, you don't what you do is that you don't trade within the range. I have a range here, like I drew from in between the high and low of yesterday. Okay, in between the high and low of yesterday. This is the low of that particular day on Thursday. This is the high, as in the previous day high and low. This blue tracer gives that is the indicator that does that for us. So you don't trade within this range. You don't trade inside the range. So you trade from outside the range. Okay, when price is driven outside the range. Okay, like here price broke the blue tracer, and here price broke it. So your focus is merely on outside the range. Okay, so the steps are as this. Number one, you identify the you identify the peak formation. Okay, number one, you identify number one number one number one identify the peak formation. Peak formation high or low, depending on the axis you're coming from. Okay. Then number two, also you have to make sure price breaks, make sure price break the yesterday's high or yesterday's low, or if it doesn't break it, it has to stay on it. Okay. Then number three, yeah, you talk about the order block. Okay, the order block. You have to identify the order block. Order block. Then number four, when price breaks the order block, when price breaks the order block from the peak formation high or from the peak formation low, or breaks order block, then step five, which is your entry, and that's it. Then these are the five basic steps. Though there are other confirmations. They also, let me say, the TDI. You can get a shark fin. You can get a shark fin as other confirmation, or blood on water as other confirmation. Then let me say sometimes you get divergence. these are some of the confirmations that that you needed on the 15 minutes time frame. Okay, the EMAs, to me, they don't matter in this strategy. So they are just there for reason. I'll tell us why the EMAs are there. Then number 7, look out for a counter trade. Look out for multi-session M and W. Look out for multi-session M's and W's for a counter trend. Sorry. For a counter trend. Okay, so these are the easiest confirmations that you can use. What you can identify 5 to 6 of them. 5 of them, I think you're good, and that's it. That's it. It's as easy as it. So these are the confirmations you use in trading this strategy. So I'll talk about. I'll try and identify this now. Okay. So on the chart, this is the peak formation high. Okay. Peak formation high has to talk about the higher high or a new high that has been formed on the intraday cycle. Okay, a new high that is formed, or this is a peak formation low, a new low that has been formed. So with this peak formation high and lows indicator, it tells you to identify the peaks, formation high and low, okay, of the day. So that is that. So number 2, the price has to, like I said, the price have to be on the yesterday's high, which is the blue tracer. This is the blue tracer. So this is the blue tracer from the low. It has to be on the higher low of yesterday or of the day. This is the London. This is the London session. So this is the high of the day, and the blue tracer, the price has broken the blue tracer. So why here is a low of the day, and price has broken the blue tracer to yesterday's low. Okay. And so this is the peak formation high. This is the peak formation low. So that is that. Then number 3, you have to identify the order block. So what's another block? So let me put this in a way that the layman will understand it. Okay, when you go through the ICT, their training, the course is somehow not clear, but there are many people find it difficult to trade the order block. So many people find it difficult. But let me just talk about the other block is just like it's as simple as this. Is the okay? We have two kind of order block. We have the bearish order block. We have the bullish order block. Okay, so the order block is the last. Let me put it this way. It's where it's like where the smart monies are located in the market. So you look for the bearish order block. You look out for the last bearish candle, before the spike to the top, or before the spike to the bottom, the last bearish candle. Okay, this is the last bearish. You look for the last bearish candle. Okay, you draw from the open and the close of the last bearish candle. The last bearish candle before the peak formation high. Let me put it this way. That's not the real definition, but put it in a way you understand it. And the last bullish candle before the peak formation. These are the order blocks. This is the bullish order block. This is the bearish order block. This is the last bearish candle before the peak formation. Okay, so once you can identify this is the last bearish candle, this red candle you see here, before the peak formation. Okay, the last bearish candle before the spike or for the move upward. Okay, so that is the order block. So you draw from the open and close. The wicks are included. The open and close of the candle. Then you draw the rectangle. Use the rectangular to draw it. So that is the order block. Okay, the order block gives the safe and the best entry so far. This I've been trading the first market. I've been in this market for a year and 6 months, though I'm new, but that's not the issue. It's for you to know if you are good in the market, if you are determined to succeed in this market, you better know these things I'm talking about. Okay, age is not a function in this market. It's knowing what you're doing. Okay, so that's the most important thing. So this is the order block. This is the order block. This is the bearish order block. The last bearish candle before the spike to the top, or the movement before the move to the top that gives you the peak formation high or the peak formation low. So this is the last bullish candle you can see in here, the last bullish candle. So you draw from the open and the close of the candle, the wicks. Okay, you draw from the wick. So for it is called a bearish order block because when price breaks, when price breaks, when price breaks it to the down. Okay, it gives a downward move. Okay, so that's it. So this is his order block I talked about. So oh sorry, I've removed it. So this is the order block that I talked about. So this is the order block. So when price breaks it, breaks the from the high and the low of the wick, or the wick itself breaks it downwards, you enter the market for a sell. Number one is where volume is located because the market maker, try to give a false move that induced buyers into the market, and he was collecting contract. That's why you see some pins here. That's why you see pins here. So many persons rush into the market without knowing that the market wants to reverse. So why those of us who trade Btmm, we know already that when we see a lot of pins from high of yesterday, when peak commission high, we know that that the price will 90% reverse from there. And also, if you trade Btmm, you know that this is a multi-session M. You can see this is a multi-session M, and this is the second leg of the M. So you have the understanding already that that's a multi-session M. Okay, and that is a multi-session M. That is a multi-session M, and you enter in an M on the second leg. So I'm just trying to make it easy and simple for us to grasp. So this is the bearish order block. So you enter on the bearish market. You enter from the bearish market when price breaks the 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 open of the candle, because on the bearish candle, price normally open. Okay, the close of the candle. You enter from the close, which is the downward wick, after the price has broken the close of the candle. Then you enter. And since the cash up, which is 13 EMA, is here, I will advise you wait for when price breaks, where price close below the 13 EMA, then you enter from there. So if you have taken if you took this market, you would have been like 91 pips in profit. Okay, 91 pips in profit. So that's just how to trade. So when price break close up below the order block, you enter the market for a sell or for a buy. So the order block, like I said, is the bearish order block is the last bearish candle before the spike total, before the peak formation, or the last bullish candle before the peak formation low, the last bearish candle before the peak formation high. Okay, why the last bullish candle before the peak formation low is the order block. Okay, so this is the peak formation low, which the indicator helps also identify, and this is the peak formation high. Okay, so you can see. So when you have peak formation high on yesterday's high, yesterday's low, yesterday's low, yesterday's high, and you see you have pins here. So like I said, you don't trade inside the blue tracer, you trade outside, but you wait for price to be driven outside the blue tracer, because that's where the volumes are looking. The volumes are in the market. The high and low of the day, high and low of yesterday, high and low of the week. So the reason why we're trading on this outside the range, because when price gets to the high and lows, okay, you expect, so that's where the market maker, they try to give a sign that the market will reverse from any moment from now. And with that, the peak formation high and low indicator helps us to get the trap move. So what the market maker do, they trap the buyers in this location. They have trapped the buyers here already, and here they trap the sellers by giving a spike to the down, a false move. Okay, they trap the trade. If you look at the last two candles, just like they try to give us a false move, especially this candle that carries which is peak formation, gave us a false move to the down, to a false spike move, and they reversed the market, and boom, it broke the order block, and it made its final reversal move. So this is a roughly 40, let me say 40 pips. So this here is 91 pips, here is 40. Okay, so you can see how they moved for the day. Then you enter when price breaks the order block. Okay, the when price break this order block, okay, a bullish order, so this is a bullish order block. So you enter when price closes above this order block, okay. So your entry is going to be on this candle. Entry is going to be on this candle. So this is the last candle that broke the order block, but you enter on this candle with with a minimum drawdown of, let me say, 1 or 2 pips, okay, and it gives you it gave you a 40 pips to the top right here. When you enter from this candle, you're able to get 91 pips. So like I said, you look for order confirmation. In some instances, you get divergence here, bullish or bearish divergence, hidden or regular divergence. Then you can trade it. So these are the likely steps. Okay, the likely steps you use in trading on the 15 minutes time frame. Okay, so what are the steps again? I talked about identify the peak formation high and the peak formation lows. Okay, so you wait for price to get to the peak formation high, peak formation lows. You wait for price to break above or stay on the blue tracer. You don't trade within the blue tracer, you trade outside the blue tracer. That is number one. Number two, then number three, on the 15 minutes time frame, you draw the order block, which is the last bearish candle. This is bearish order block from the peak formation high. You look out for the last bearish candle. You look out for the last bearish candle before the peak formation high and the last bullish candle before the peak formation low. Then you wait for price to close it or break it, close above it. Then you enter from there. And normally my stop loss is normally above the peak formation high, just small. I don't dash money back to the market. I set a very tight stop loss. So whenever price breaks it and I close the trade and I wait for it to come down again, then I enter the market. I don't give a big stop loss. That is me personally. I don't dash my money back to the market. So that's just my ideology of trading. So we go to 4 hours now. Like I said, you can trade this strategy from 4 hours and 15 minutes. Like I said, the bigger the time frame, the bigger the volume. So when you go to 4 hours, you will see a bigger moves, but same principle, same ideology. Okay. When I mean same ideology, I'm talking about the chart volume, where volume are located, the high and low of the day, the high and low of yesterday, the high and low of the week, and the high and low of the month. So once you can identify, sorry, once you can identify these locations on the chart, then you are gained. Your success of your success will be your rate of success will be high, and as you trade, I'm going to go to 4 hours now. I'll go to 4 hours and let me change the pair. I'll go to 4 hours and give us a clear analogy from there. So okay. So this is 4 hours. We're going to focus on some key confirmations on this 4 hours. Okay, some key confirmations. Okay, let me remove the other block I drew before. Okay, so this is 4 hours. This is a 4 hours time frame. Like I said, the higher the volume, the higher the time frame, the higher the higher the locations where you see more volumes in the market. I talked about if you want to spot volume in the market, you go for places of high and low of yesterday, high and low of the day, okay, the high and low of the week, and the high and low of the month. So with this indicator that I have on the screen, it enables us to see those locations. So this is the monthly high. That's how you see peak formation here. This is the monthly high. So this is the monthly high. Okay. So here is the previous week's low, as you can see here with the indicator. The previous week low. Yeah, this is this is no, the previous week high is the previous week's low. This is the previous week previous month high. So with this indicator, I'm able to see these places easily without any struggle. Okay, so this indicator just points out this thing for me. So what are the confirmations on this 4 hours time frame? Number one, I will itemize them, but let me just talk about them. So you look out for number one thing, like I've always said, you look out for the peak formation highs. You only trade from the peak formation highs and lows. Okay, so let me talk about the quarter theory. The quarter theory is one of the best let me say in the system in the market, which identifies the support, easily identifies support and resistance and key levels and whole number locations in the market. Okay, I use them as support or resistance. And on the quarter theory, we have four major quarter points. Okay, but I focus mainly on two, which is the round number or the whole number. These are places where you see 0, 0, 0, 0. So the seasonal trader, they tend to reverse the market in those locations. And also the the blue dotted line, which is the hesitation point. Okay, which is a hesitation point. When price gets to those places, they tend to convey the market. Okay, so you can see this is the round number, and this is the hesitation point in the quarters theory. And we have other ones. We have the quarters theory, the half point, then and this other one. Okay, and the quarter point. So we have the four positions in between the round number. We have 1,000 pips. Then we have the 750, the 500, and the 250. Those are just so in between that. If you go to the daily time frame, you see it very clearly. So I'm not concerned about that. I'm just concerned mainly on two of them: the whole number, which is the round number, and the hesitation point. So these are the two key quarter points I'm interested in trading this market. So, like I said, the principles are the same, but just that instead of us looking at the higher low of yesterday, now we're looking at higher low of the week and higher low of the month and that of the previous month. So these are places where you see volume in the market. That way you see volumes. So, like I said, the market maker, he beats price to those locations, and what when price gets there, they give us some signs and signals that okay, reversal likely happen. So you look out for from the peak control, you look out for M's, look out for W's, look out for inverted head and shoulder, head, shoulder. Then you also spot you enter using the order block. Okay, so if this trade has not played out before, it is very, very simple to trade this market. So I will start with this one from here. I will start with it from here. First of all, let me zoom it closer for us to see. Okay, so for instance, so this is, like I said, the steps are easy. Number one, you identify the peak formation high. So for this indicator, this is the peak formation high. Okay, this is the peak formation high. Then number two, you identify the order block. You can use a doji. You can use the last bearish candle from the top. Okay, so a doji gives a doji is a two-way candle that it is neither a fight that is won by the bulls or the bear, just like a drum match. Okay, so you can use a doji or you can use the last bearish candle, which is here. But I choose to use this. This doji from here. So choose this doji. So this is the bearish order block here. This is on the forward time frame. This is the bearish order block, the last bearish candle before the peak comes on high. Then number two, I talked about I focus more on two quarter points. I talked about the hesitation point, which is the blue dotted lines you see on my chart, and the round number or the whole number. Okay, so whenever you see price, so okay, let me give you the list of confirmation on the 4 hours time frame first before I talk about it. Number one, we talk about the peak formation high or low. You identify it. Peak formation high or peak formation low. Number two, price has to be on the hesitation point or the round number. quarters point. Number 3, identify the bearish bullish order block. Number 4, enter when the order block is broken. Number 5, TDI confluence. TDI confluence, that is a shark fin or divergence or blood on water. Sorry, or blood on water. These are the on that. Then okay, sorry. Also then on the price has to be on. Okay, price has to be on hesitation. Okay, then on weekly high. Oh, sorry, in between. On low, monthly high, on low, monthly high on low. yeah. These are the 5 may confirmation on the 4 hours time frame. This is the peak. This is a peak formation high. For instance, this is the peak formation high you're seeing here. This is the peak formation high you see here. You can see that the price is on the hesitation. At that time, it has formed the monthly high. 1, 2, 3, 4. This is this month, for instance. So it has formed the monthly high or on previous high of the month. So whenever you see peak formation on the hesitation point or on the whole number or on the previous month, these are the locations you see on the chart. Whenever you see them, you see the peak formation highs on hesitation point, the quarter story or the round number, monthly high, monthly low. For instance, then you identify the order block, the bearish or the bullish order block. The last bearish candle here you can see. Okay, I think I should draw for that of the bullish order block here. This is the last bullish candle before the peak formation low. This is the last bullish candle you see here before the peak formation low. So this is peak formation low. You will see here on the hesitation point as we talked about. It has to be on the hesitation, on the round number, or the monthly high, the monthly low, previous monthly high, monthly low, or previous weekly high or weekly low. It has to be on them. Then you identify the bullish order block or the bearish order, which are the last bearish candle before the peak formation high or the last bullish candle before the peak formation low candle. Okay, or the candle against the peak formation low. You expect to it down. It must not be the candle, but the last bullish candle or the last bearish candle before the peak formation. Okay. Then number 3, you draw the order block. You have to draw the order block, identify the bullish or bearish order block, and you draw it. Then you when the order block is broken. So this is when the order block is broken. It broke and it did a 1 candle retest, and boom, it made its move here. It broke and it also made its move. So these are just the 5 to 6 confirmation. Then you look out for TDI confluence like a shark fin. Look out for a blood on water and divergence. So these are some of the confirmations. Okay, like Ronaldo Beijing, like what he did. he combines the 15 minutes and the 4 hours together while trading. So that gives a better confirmation on entry. But as for me, I focus more on 15 minutes. I don't, unless I want to trade the 4 hours time, I go to the 4 hours. Okay. Because your entry will still be on the 15 minutes. If you're trading most of the time, you enter on 15 minutes. But if you're a position swing trader, you see the same principle, but you trade from the 4 hours. So that is that. So let me clear everything and focus more on the trading aspect of it. Okay. So so that is a so let me say for instance, look at here, for instance again. Look at price here. Price this is peak formation low, peak formation low, and is on the previous this is the market monthly low, and is very close to the hesitation point. So your target is mainly on the hesitation point, which is the dotted blue lines and the quarters theory. Okay. And when price is at those points, okay, at the peak formation low there, you draw your bullish or bearish order block. This is the last bullish candle before the move, before the this is the last bullish candle or the spike to the down or the peak formation low candle. So this is the bullish order block. So you wait for price to break it, then you enter. Mainly it does a retest. Like here, he went up and did a retest before it made its final move. He came here and he came down again, and boom, there it goes. His final move, which is 169 pips. You can see 169 pips. So that's that. So that it is. Even from here as well. Look at this one as well. This is a peak formation low. So this is the last bullish candle, bearish order block. You can see is on hesitation as well. You can see is on hesitation too. This is the weekly low. So you look out for the weekly low, look out for the monthly low, look out for the monthly high, weekly high. So on these points, and you have a peak formation, they look out for the last bullish or bearish candle. You look out for the last bullish or bearish candle. Then you take the trade. Look out for the last bullish or bearish candle. When what is a breaker, you enter the market for buy or sell. There. If I were to trade this market, I would set my stop loss below this peak formation low. Here is going to be my stop loss just after the hesitation. Here is going to be my stop loss just after the peak formation high. Okay, that is my stop loss. Then you can see a TDI confluence here. A TDI confluence. It gives us that the market is going to rise. Then look out for the market baseline on the TDI. I see that it's below 32, which has given us a signal that the price will likely the trend of the market would likely change from here. You can see. So whenever price is below the market baseline or above the market baseline, you have a signal that the price will change here as well. This downward move also gave us a price. The price is almost at 68 here. So it gives us that the trend is changing as well. Here as well. Here, but it's not on 32. So but there's big commission low and it's on hesitation. You can see it's on hesitation. Hesitation, they draw the bullish order block. You wait for it to break and you enter the market from this candle. Here you go enter from this candle because this is the close after the breaker. Enter the market from this candle and boom. Here you go. Here same time. You can see this one on the whole number. So this is the bearish order block, the last bearish candle before the last bearish candle. The last bearish candle before the spike to the top. Okay, this is so you wait for the price to close and is on the whole number. So we're expecting a reversal. So we saw this peak commission high. This is peak commission high. Then wait for the price to close above the last bearish candle, which is the bearish order block, and wait for price to close above it, below it. Okay, and you can see that just like in the second leg of an M here. Okay, for price to close below it, he did a retest and boom, here it goes. He did roughly in 129 pips. You can see that. So it is easy when you're trading this strategy. Okay, It is easy when you trade this strategy. So these are some of the locations in which you can trade and make money from. Okay, like here as well. Okay, like here as well. You focus on mainly on the whole number, on the hesitation. This is a peak commission high. This is 4 hours time frame I'm dealing with here. 4 hours time frame. The peak formation high, hesitation broken, price just broke the hesitation, the last bearish candle before the order block. Okay, then you draw the order block whenever you have a breaker. So this is the candle that broke it, but it did a little drawdown before it made its final move. Before it made its final move, and it gave us 259 pips. Okay, so I'm just trying to point for us. Okay, look at here as well. Look at here as well, a bearish order block, but the market range a little bit from here. But as a position trader or as a swing trader, it's not going to bother you because your pips are big. But personally, I will not leave this market until price breaks above the peak commission high. This is the peak commission high. Here is my entry when price breaks the order block, and price did not break the order block until this candle here. It broke it and it did a little drawdown and boom, it came downwards. So you can see this one as well. This is the peak formation low on the hesitation point. This is the last bullish candle before the peak formation low, which is the bullish order block. Okay, so you enter the market where price breaks above it. So this is the breaker, this is the entry, and here, if you are a swing trader, you are in 603 pips. Okay, you can see we focus more on the hesitation, which is the blue dotted line, and the whole number, then the previous high of the week, high of the month, and that, and so on and so forth. So you can see that this strategy is very easy and is very good to trade. If only you can identify the peak formation, you can identify the order block, you can identify, look at this one as well, peak formation, you can identify the order block, you can see it just playing out well. Okay, look at this one, peak formation high, but this time it's not on the hesitation, it's not on the whole number, but it's on the quarter. Okay, on the quarter story is the last the last bearish candle. Okay, once you have the peak formation high, look out for you draw the order block. Okay, you enter from this candle with the breaker, you enter from this candle. It did a little drawdown of, let me say, 10 pips or so. It did a retest, and it came and what it broke, it did a retest, it tests the order block again, which is called the mitigation block. Now the retest is like a refilling of the order block, which is called the mitigation. Those who trade ICT, they know what that means, and that is the downward move. So the retest just like that now, which is 275 pips for those who do swing trading. They're in big money. So that is just how to trade this strategy. So I believe with this idea of the order block, which gives us a confirmed entry, and 90% of the time you win your trades. 90% of the time you win your trade. As we all know, no strategy is a holy grail. So we trade carefully. Okay, we trade carefully. So that is just the combination of ICT and the ICT with Btmm, and that is that. So my name is Festus Omoemu, and that's just the pattern which I trade, and it's very very good. You learn this order block with this video. I believe you might have known lots of things about this strategy. So you trade with care. As we all know, no strategy is a holy grail. We'll look out for strategies that will give us good entry, because when you have a good entry in the market, you succeed more in the market, and strategy that will give us little drawdowns from the market. And with this strategy, your drawdowns are very very minimal. So you trade with care, and success is yours. Thank you.